Cool, cool, cool. Got it. Let's bring this down right quick. Hold on. Bring this down. All right, cool. So one of the key words I want to talk to you today about is momentum, because momentum is always the biggest thing you want to understand when it comes to the stock market game. And so, just like in the stock market in life, people always want to connect with the trend. People always want to connect with the trend. So there's going to be some stocks we just know that are hotter than others. There's going to be some stocks that everybody in the country want to buy, the Apples, the Nvidias, the Amazons. Now they might have companies that might, let's say be a company that sell fertilizer. Well, people ain't gonna really want to buy those companies because it's not really hot and trendy. So I want to talk about momentum because momentum is like a basketball game winning streak. When I was younger, and Tiff would know this, but Ronnie probably don't know this because he wasn't even born. But when I was younger, the Chicago Bulls was a phenomenon. Like when I probably catch the last 2 or 3 years from that stretch, which is that 95, 96 season, 96, 97, and 97, 98. And pretty much everybody in America had a Chicago Bulls jersey. Either you had a Pippen jersey or a Michael jersey or a Dennis Rodman jersey. And that was just a phenomenon. No matter where you went in the country, people wanted to go see Michael Jordan. So that key about momentum is like just imagine like you have a team, right, that you like, and that team is on a winning streak. Every week they're winning, like a football team. Let's say the Patriots. Every week they're winning. The stadium packed, the fans are excited, and even people who you don't even usually want to show up to the game, they come, right? I remember back in the Bulls, they had women coming to the games. They don't even know what's going on. Couldn't tell you what a 3-point shot was, but it was this excitement. It was this energy. It was this rush. And because you had this hot team in America that was breaking the charts, that was winning multiple championships, that was going back to back to back. Michael Jordan was the best, arguably the best player in the world. Everybody wanted to get on that bandwagon. And so because the team was hot, everybody wanted a piece of the action. And that's how a stock is. Once a stock gets hot, once a stock is in the news, once people start seeing that the product that they have is hot, like something like a Lululemon, where girls literally pay $100 and $200 for yoga pants, right? But we know women can go buy Reebok yoga pants, they can go buy Adidas yoga pants, they can buy Nike yoga pants, and they can get a cheaper price. But because they want to be a part of that trend, they want to be a part of that fad. They want to go in and connect to Lululemon or Alo or all these just different things. So just like with stocks, as long as people keep winning, more fans will come. As long as the company is keep winning, as long as the company is hitting projections, as long as the company is in the news or they have hot products, more and more people will come. And even people who don't know about stocks, even if people who don't even know about investing, everybody's going to want to get a piece of that action. And that's just basically momentum. And so when a stock is going up, a couple of things happen. So when the stock goes up, it gets more traction. So you're going to see it on CNBC. You're going to see it on Bloomberg. You're going to see it on you'll see it even on other news channels. You might see it on the morning show on CBS. You might see it on all kind of other places where they're getting traction where you usually don't even get a sports story. Excuse me, a story about that stock. So the stock goes up, more investors notice, more buyers jump in. Remember on last week we told you buyers are sometimes irrational, right? We talked about fear of missing out. So when people see other people making money, when they see their friends making money, when they see their parents making money, when they see their cousins and everybody around them making money, they want to make money too. So they're not, some of these buyers might not even buy because of the company, but they just buy because they keep on seeing the chart go up and people want a piece of that action. So all of that create positive momentum, like the winning streak of a basketball team, and that'll push the price higher. Now, when a stock is falling, on the opposite, it's like that basketball team. Your team lose 30 games, like the Pelicans, and you're gonna get less people want to be a part of it. You're gonna get less ticket sales. You're gonna get less people want to even come and watch the game. People not even going the ratings on TV is going to be low. People won't be able to sell tickets. So the same thing with a stock. When the stock is falling, people will panic. People will rush out. The buyers will begin to get scared, and that's what create negative momentum. Now watch this: positive momentum or negative momentum. It could also don't even have to rely on the stock metrics or the underlying numbers. I know people who are buying companies that are not even making profit are making revenue. They're not making any money at all. Like, and what do you mean they're not making money? Well, they have revenue, right? That's just all that they take in. But after expenses, after taxes, after amortization, after paying employees, they have no profit. But people will buy these companies, right? And or they'll buy a company in a niche market, right? So what do you mean by niche market? It's a market that's trendy. So it'd be like there's a company that I've invested in called Oatly, which is oat milk, right? Oatly has health benefits. It's better than traditional milk. And so there was a whole branding campaign around Oatly. Well, when I first bought Oatly, there was a whole campaign around it. It went public, and people were just talking about this craze. What's the sense of buying regular milk when you can buy Oatly? Well, we started to see things started to happen. The pandemic started to happen, and people really was cutting costs. They didn't want to pay for the price of Oatly. And then not only that, when people buy oat milk, also people really don't care about a brand when they're buying specialty types of milks. So if it's oat milk, they just want to get the oat milk that's the cheapest milk. Now we know that might not correlate to me being the healthiest milk, but people just when people are buying or they're in the market for something, if it's not something that they truly desire, then they're not going to want to buy it, buy a specific brand. They'll just buy anything that's really complementary to their desire. So whatever their desire good, they'll buy that product according to their desire. So we talked a little bit about momentum. We talked about negative momentum. I'll give you another analogy about that, and then we'll start going into the analogies of the metrics that you need to look for in stocks. So when you are, let's say you go to a party, and everybody in here, I'm sure, has been to a party, whether it's a college party or a regular party. Imagine you get invited to a party on a Friday night, and you get there and nobody's there. Or maybe let's say two people there, three people there. Let's say you get there early. Let's say you even get there late. Nobody's dancing. The music is there. The music is on. The lights are on, but it's quiet. So you rationally, when you come to a party, you want to see people. You want to see movement. You want to see good music. You want to see a DJ. You want to see some active momentum. You want to see some things shaking. You want to see people talking, having a good time. Maybe some good food, good drinks, or whatever. You want to see some action. And if you go to a party and that ain't no action, you're just like, you know what? Maybe I just leave. Now, let's just say if you drove out that door and you come back around in 30 minutes and they got about 500 people in there, what you're going to do is you're going to double back, right? So now you want to stay. Now, why would you want to stay? Because you started to see active momentum. And people are irrational. When they come to investing, they need to see signs of other people buying with them. And this is why a lot of people lose in the stock market because that could be a company that is doing great, making a lot of money, making a lot of profit, but a lot of people just don't know them yet. A lot of people just don't know the company yet. Could be new. The product is probably ahead of its time. So this whole AI craze, AI has been out for many years, right? The technology's been out, but you started to see in 2024, everybody just started connecting to it. You started seeing everybody, once Chat GPT and Sam Altman started releasing Chat GPT from OpenAI, you started seeing a whole bunch of people starting to connect with it. And that's just how some companies are. Sometimes it takes years before a company gets notoriety even though they're doing good work. Sometimes it takes years for a company to get notoriety, even though they're doing good work. So there's a couple of things that move a stock price. So we told you stocks is basically supply and demand, right? So we're going to talk a little bit about what makes supply and demand change in the stock market. We're going to talk a little bit about what makes supply and demand change in the stock market. So the biggest thing is we told you on 4 times a year, the company is going to have earnings and revenue projection. We told you on 4 times a year, the company is going to have earnings and revenue projections. So right now, I'm gonna get your question. You know, I like to answer those questions right on time. So I'm about to answer that question. So you said, let me see what you said on your chat. Hold on. You said, what's a good way to go about finding some of the smaller companies that may be on the rise? That's good. So what you need to really look at, you can't really look at earnings because if it's a newer company or it's a growth company, then they probably not earning money. But you need to see consistent on consistent earnings growth. So if the revenue margins or the growth margins on the revenue is explosive, let's say the company makes $100 million, right? And then the next year it makes $150 million, right? So they got a 50% gross margin on its company. That's a positive, that's a positive sign that will show you that company one day is going to become profitable. Because one day, if you already know, just like in life. So I'm gonna just use this for you. So let's just say if you're making $5,000 a month, but your bills are $4,000 a month, right? Which gives you $1,000 to use for yourself, right? You didn't take care of all your bills. That's your lights, your water, your rent, your mortgage, whatever you got, your food and everything. But you got $1,000 of supplemental income just for the month. With that $1,000, you're gonna really try to make sure you can manage that wisely because you have, even though you're making decent money, you got to manage that money wisely because you don't want to go broke. But let's just say we up your income to, your potential is growing. People like you at your company, right? And they say, man, Ronnie, we like you. You're a good accountant. So we want to give you a raise. And so your earnings potential is growing and growing. So once you start making $15,000 a year, I mean, $50,000 a month, and now your expense is still $5,000 a month, now you got $10,000 extra in income. Now you got $10,000 extra in income. And with that $10,000 extra in income, guess what you can do? You can afford more things. You can go to a restaurant. You can take your lady out. You can do all kind of stuff that you couldn't do. And that's the same thing with these companies. If the company is growing revenue, right, is what they're taking in from all the products and the sales and the services. If that continue growing and they keep expenses the same, then one day they will get profitable, right? Or even if expenses is growing, if expenses is not growing at the same rate that revenue is growing, then the company is going to become profitable. That's a small way to look at it. So that just say if the company make $500 million in a year, expenses is 400 million, but the next year they make $700 million and the expenses is 350. Well, you're seeing they're becoming more profitable. You're gonna see them get profitable. And that's just a small way to look at it because a lot of people say, well, what about if I just look at the company for the earnings? Well, the company might have negative earnings with positive growth momentum. And I think a lot of novice stock owners or investors, they don't really look at positive growth margins. They just look, well, the stock says negative, so I ain't gonna buy it. And that could be a smart way, but you might miss out on some good deals. I bought a lot of companies that had high growth margins, but just was not profitable. So that's one way to look at it. And if y'all got a question in the chat, you can always put it in. I'm always trying to answer it in really in real time. So one of the first metrics you can see that's going to move a company's stock positive or negatively is the company earnings. So that's the profit. That's how much the company made each quarter. We told you 4 quarters. Right now, we're in earnings season right now. So CNBC this week, if you just watch CNBC this week, you're going to see a bunch of earnings. Like Tesla just had their earnings. Pretty horrible, but they gave some forward guidance on some of the new products. So people really didn't sell that much because they know it's going to take time for them to fix their situation with Tesla. So when earnings go up, the stock price usually goes up. Strong quarterly earnings. Okay, we told you every 3 months. That's 4 times a year. The company is going to tell you about their earnings. They have a conference call that you can be on as an investor because we told you when you're investing in the stock, you're an owner. So if the quarterly results go up, it attracts more investors. More people are going to buy. That's going to make the stock price go up. You're going to make more money, right? Now, if the company reports better than expected earnings, you're going to see the stock go up tremendously. So let's just say if Apple says, okay, we're going to make $400 million in this quarter, but they make $800 million, you're going to see people trying to hurry up and get it because they say, oh man, they made way better than their projections. If they're making this money this explosively like this, they're going to continue to make money. Second thing that makes the stock price go up is news and announcements. So big news, negatively or positively, can impact the stock price fast. So if a product launch, right? Let's say Apple dropped the iPhone 17. I always tell you that's one of the times I start buying Apple is in the fourth quarter around September when they start dropping the phones. Why? Because Apple's biggest revenue driver is the iPhone. They don't sell that many iPads because that's a niche brand. The average person is going to hold an iPad for 4 years. The average person is going to hold their computer for 5 years. So, you're going to pretty much trade in your iPhone every year. So that's pretty much the largest revenue driver for Apple. So if you really want to get a quick fix or making some quick money on Apple, usually if you buy between that third and fourth quarter, between August and like November, you're going to make some good money. Usually about 10%. That's when they usually make the biggest money. So product launches, specialty services, because every business don't have to sell a product. It could be a service, right? Like Zoom is a service, right? Online digital service, cloud service. Um, Lawsuits or scandals, right? Sometimes a company can sue the government. The government might had a law which was over regulation. They put more regulations than what is allowed on the company, and the company can sue the government and make money, or the government can sue the company, and the company has to pay fines. Maybe they did something with their product that they cut corners, or maybe they hurt people. Remember when Chipotle, we talked about, they had the salmonella outbreak. All these things can happen, and people could start suing, and that could be a negative events for the stock. Companies can get bought out through mergers and acquisitions, right? So a company can get bought out by a bigger company, right? One of its competitors. Let's say the company has not been doing good and company's worth 15 billion, and then another company comes out who's worth like $1 trillion. And you know what? We want to buy your company, and then you will merge with us, or we will acquire your company. And that could be positive news for both stocks. One of the stocks that I recently bought originally got acquired was Vizio. So I bought Vizio probably at $9 a share when it went to the IPO probably in 2023, and they got acquired by Walmart. And when they got acquired by Walmart, the stock went up to like $13. So maybe about 13, 4, 30, about 30% on that stock just by Walmart buying them out. So that's always a good deal. If you do buy smaller companies, Ronnie, one of the good things about some of these smaller companies that do business with these bigger companies, sometimes the bigger company will buy them out, and that's a nice quick hit for you where you can get some good cash. So basically, when that happens, they got to pay for the stock above par value. So what Walmart had to do, they had even though the par value, which is the original price of the stock, was like $9 for Vizio, Walmart had to pay every investor who invested in Vizio $13, which was $4 above par value. So that was probably like somewhere between like 35, 40% gain right there. So those things do happen. Um, we're in a season right now where there's economic indicators. So, depending on the product or service, if there's inflation, if there's unemployment, if there's interest rates fluctuations, that can negatively affect the stock, right? Because in order for consumers to have more money in their pocket, interest has to be cheap. So right now, you're seeing that it's 7%, 6.7 to 7% for a house or a car. For young consumers, this is probably the highest you ever bought a car. The interest you ever bought a car, this is probably the highest you ever bought a car for. So that takes the money out of your pocket. So some of these Stocks. We talked about cyclical and non-cyclical stocks. Some of these cyclical stocks that depends on the consumer having money in their pocket. Some of those stocks people won't buy, right? So um, you look at a expensive restaurant, like a five-star restaurant. People might say, you know what, I got two, three kids. I might not go. I might go to a five-star restaurant maybe once or twice out of the year instead of six times out the year. So these things do happen, and those are things you got to watch out. So if a bad economy happens, people may have to sell their stocks to get money, or they're scared of where the market's going to go, and so that'll make prices fall. If the Federal Reserve raises interest rates, we told you interest is the price of money, right? Like we're seeing now, more and more people will not want to buy, cyclical stocks or stocks that people have when they usually, companies usually buy when they have more money. So everybody know that when you have more money, you spend more. The less money that's in your pocket, you try to keep it, because you never know what the economy might do. So another thing is, people will buy on industry trends. So let's say a new pair of Jordans come out and they look good. A new pair of Jordans come out and they look good. You're going to see a lot of people want to get on board and really try to connect with the trend. Let's say LeBron James come in there and say, "Hey, we got these new LeBrons." Because LeBron James is a winner, everybody want to feel like LeBron and be a winner. I remember when I think it was the Jordan 13s came out. I think that was in like 98 or 99. Everybody wanted to be like Mike. He'd say, "I want to be like Mike." And everybody thought, they wanted to, you put the Michael Jordan shoes on. Everybody thought you was gonna be, number one. You was gonna definitely, be dunk, even if you couldn't dunk. We just thought you put Michael Jordan shoes on, it was gonna give you life. So if everybody can see the screen right now, I want to go over a couple of indicators about some basic things on how to look at a stock chart because you're gonna really need this, right? So the first thing I want to look at is right here. And this is what we call a ticker symbol. So why the ticker symbol is important? Because if you want to buy the stock, every stock has an abbreviation by ticker symbol. And you can't buy the stock unless you know the ticker symbol. Now, I know y'all what y'all gonna ask me. Of course, now everything is so simplified. With Robinhood and with Cash App, all you got to do is type in the stock name and you can buy the stock. You don't got to worry about the ticker symbol, right? But back when I was buying stocks over 16, 17 years ago, you needed to know the ticker symbol. If you did not know the ticker symbol, you were not able to buy the stock because if you were on E-Trade, you had to know the ticker symbol. And so that's why I can recite all these different ticker symbols, verbatim, because, back in the day, as long as I've been investing, you had to know these ticker symbols, right? So now that you know the ticker symbol, now that you know the company, the second thing you have, we call this is the last price. Now, before I go to the last price, the ticker symbol only means it's a short code that represents a company. And it matters because it shows how stocks are identified on trading platforms. So, just like you have a social security number and all kind of identifiers, the ticker symbol just shows how the stocks are identified on trading platforms. So the last current price, as you see, there's two different prices, and I'll tell you about those two different prices. The last current price is the most recent price at which the stock was bought or sold. So the last current price is this price at the close. So if you're on the East Coast, the stock market closed at 4 o'clock. If you're in the Central Standard Time, the stock market closed at 3. If you're on Pacific Time, it closes at 2. If you're on no on 1 at 1. If you're on Mountain Time, it closes at 2. Okay, so it's going to change depending on what time you're in your time zone. Okay, so when the stock market closed at $199.74. Okay, so why does that matter? Because this tells you what you paid for, right? Or what you would get if you traded the stock right now. Now, in the after hours, people can buy stock after the stock market is closed. And this is a good way to show you the momentum. So, right now, we believe, now, this is not always the case. This is just an indicator that in the morning, if all things stay the same, the price of Apple is going to be trading at $200.05. So if you have Apple stock, more than likely, if nothing happens, right, if there's no economic indicator, if Trump don't get on Truth Social and say anything crazy, if the market stays the same, because we have something called market futures. And market futures is basically an indicator or a prediction on how the market is going to open before it opens based on buys and sells that people are buying and selling stock in the after hour markets. So, like, say, if you would go to your E Trade or if you would go to your Robinhood and buy Apple right now, you'll be buying Apple in the after hours market. You'll be buying Apple in the after hours market. That does not mean that you're going to buy Apple at $205 a share. Okay. Because this can go down, it can go up. Whatever the stock market opens at 8:30, 9:30 Eastern Standard Time, that's the price that you have to buy it for. So this is only just an indicator to let us know right now, possibly the stock market is going to perform well tomorrow. So it's just basically a future prediction or indicator to show how the market is looking. And so this market is just showing the buys and sales of Apple stock. And there's more buys than sales right now. So it's looking pretty good. So in the after hours market, it should, it should tomorrow be positive news. Okay. So the day change will give you a percentage, right? So as you can see, Apple was up 6.58. That's dollars, and that's 3%. So, people always talk about price. I tell y'all, don't chase after stock prices. What do we chase after? We chase after percentage. Hold on, I want to get this in the chat. Let's see what we got. Hold on. Can that be a drastic change in the future market price? Oh yeah. Oh yeah. I'll show you one right now. Tesla. So you one right now. It could be a drastic change. See that change right there? After hours, $12, 5%. That could be a huge change. Tesla just had the earnings. They did forward guidance. They were talking about some of the new cars that they're going to do, the new robo taxi. So yeah, you can have a dramatic price. That don't stop nothing. So you definitely need to be watching also the after hour market too, because we again, this could change on a dime. But right now, we still got about another probably 13, 14 hours for the market open. So again, these numbers can change based on some information that's coming right from a large bank, institution, the federal government. All this could change. But right now, from the information that we have, Tesla could possibly open at $250 a share. Tesla could possibly open at $250 a share. All right. So the day's range, now I'm gonna get to the bid and ask too. The day's range just tells you what the stock is trading at for the day. So it shows you how much the stock has moved today. So at the low side for the day, Apple stock, you were able to get it for $196. At the high side, we can get the stock at $201.59. Okay. The 52-week range is a powerful indicator to let you know the price of a stock and to see if the stock is expensive for its range. So we see right now Apple closed at 199.74, but it's been trading in the range of $164 to $260, right? So right now, compared to last year or the beginning of the year, Apple is trading a little bit right, almost at a discount or a fairly valued price, right? So if you were buying Apple stock, this would probably be a good time to probably buy it because it's in a good positive trading range, right? When it was in 260, it was probably overbought, high, expensive. Now I'm gonna show you. I'm gonna show you guys a little simple way to know if a stock is expensive or not. Okay. So we said uh the days range, right? Shows how much the stock has moved that day, both in dollars and percentages. And why that matters is it shows whether the stock is up or down compared to yesterday's closing price. So it shows the stock being up or down compared to yesterday's closing price. Okay. The volume. Now, what is the volume? Try to highlight that for you. The volume is just the total number of shares traded today. So 51 million, almost 52 million shares traded hands between people. And that's whether buys or sells. Doesn't matter. It shows you how many people, the activity of how many shares was moved. Now, why this is important? Because the more shares that are in volume, the more liquid, listen to me clearly, the more liquid that stock is. And liquidity is important because you want to be able to get rid of the stock when you want to. So let's say you make $100,000 on a stock, but it only got, let's say, 100,000 shares or 200,000 shares. Well, that stock is not liquid. Therefore, you might have to hold those shares until you get a buyer. When you got millions of shares being traded between hands, right? It's easily liquid to sell your shares. When you got 50 million people trading shares, you got 100 shares or 1,000 shares or 10,000 shares. It's easy for you to get rid of those shares in a day. So that's why volume is important. So that's something that you should look at because that lets you know how many shares are being traded between the buyers and sellers. High volume means more activity, right? Often tied to big news or it's companies that investors are interested in. Simple as that. So the average volume, you see the average volume. How's that different than volume? It's the number of shares traded per day over a period. Usually that period is 30 days. So that helps you to know if the volume is normal or unusual, right? So if the average volume, is 61 million, and right now today, 51 million shares were traded, you know that the shares are traded under the average volume. And let's just say 100 million shares was traded, right? We know that's not normal volume. So now you got to find out what's going on with the stock where 100 million shares are being traded. Why so many of these shares are being traded? Did Apple, launch a new phone? Is the company doing well? All this news you got to find out to see why this company is above its average value. Okay. So one of the big things is market capitalization. So market capitalization is the total value of the company's stock in the market. So how do you find the market cap? How do you find the market cap? You have to multiply the share price times the number of shares. Share price, which is 199.74. So we can just say, how many shares does Apple have? So boom, it's say about 15 billion. So you multiply 15 billion times 199.74. And that's going to give you the market capitalization. Tell you how big the company is. Simple as that. Now, beta is a big thing. This tells you how volatile a company's stocks moves. This tells you how volatile a company stocks moves. So if you got anything under one, the stock price doesn't move rapidly. You're not going to see rapid swings in the price of the stock. But there are some companies, like some new tech companies, that got a 2 or a 3 beta, right? That means you're going to see some tremendous high swings in the price of the stock. It can go down $10, $3. So Apple, even though it's above 1, the beta is not that volatile, which means that the stock price is not going to move that volatile. But if I compare that to a company, let's say Tempest AI, right? You're going to see a 2 or 3 beta on Tempest, right? Let's see what the beta is on Tempest. Or they don't have a beta. Let's see if we can find a. I know Tesla beta probably going to be way more than Apple's. So yeah, see the beta on Tesla. That means the volatility on Tesla is way more volatile. That's why, Ronnie, you get these big price swings like this. So just know, on the downside, the stock can go down a lot. On the upside, stock can go up a lot. So that beta lets you know how rapid the price of the stock can go up or down. Beta is very important. So if you got a question on beta, just let me know in the chat. I just want to make sure everybody knows this. Now, one of the most important things about the stock is the price to earnings ratio. We call it PE ratio. So this lets you know how much investors are paying for $1 of earnings. Right? So what you do is to get the earnings per share, you divide the stock price, which is $199.74, divided by the EPS, earnings per share, which is 630, and that should give you the PE ratio. So I'm gonna do it. So 199, you can go on your phone and do it. 199.74 divided by 6.30, and that gives you a PE ratio of $31.70. Now, if you want to see if Apple is expensive compared to how it was trading before, all you got to do is say, let's go to Google. You can say, what was the last, give me the last 5 years of Apple's PE ratio, right? So 2020 was 33 PE, 2021, 26, 22, 28, and 34, right? So now we go back to 25 and we can say, oh, this PE ratio might be a little bit expensive. Why? Because the average, if you do an average, you're going to see on the average, the PE ratio is just trading somewhere. If you did 33.9 plus 20.5 plus 22.3 plus 26.7 plus 34.7, you divide that by 5, it's going to show you the PE ratio is 27.62. So this company could be trading a little bit overpriced to its traditional range. You also have to look at revenue and earnings as well, because the past performance says it trades a little bit under this. And if you got a question, just put it in the chat. So sometimes you got to look at the past to give you a prediction in the future. Now, we know right now, Apple is about a fair value estimation. That don't mean it ain't gonna go up. It just means it's fairly valued or maybe a little bit overpriced. So what I mean by a little bit overpriced, it might be about $10 overpriced. But that don't matter about the stock, because the stock can still go up. Because remember, if Apple continues to produce good revenue, good profit, and they're growing year over year, then guess what? They're going to make more money. Again, earnings per share tells you for every dollar of earnings compared to the stock price you pay. So, Ronnie, your question would be this. So, with Apple, you're paying $31.70 for every $1 of earnings. $31.70 for every $1 of earnings. So if you want to see if Apple is cheaper than another company, right? We'll look at, let's say, Microsoft, which is a competitor. You want to say, well, I want to buy Apple or Microsoft. How do I know which one to buy? Okay, let's go take a look. So Apple's Microsoft P ratio, 29 and a half, right? So for every $1 earnings, you're paying $29. And look what it's giving you. It's giving you more earnings for what you pay. It's giving you more earnings for what you pay at Microsoft. So just as a guesstimation, with, with all things being equal, just with all things being equal, of course, there's other factors. You got to look at the product launch. You got to look at what's selling. But with all things being equal, if you look at that you're paying less for Microsoft because you're getting more earnings for every buck that you pay, Microsoft would be a better stock to buy than Apple if everything was equal. We know everything is not equal with these two companies, but I'm just saying, I'm just showing you how the investor thinks when they're buying the company. If everything being equal, Microsoft is paying you more earnings per dollar. Even though the stock is more expensive, we don't look at the stock price being more expensive. We look at how much we're getting paid as the investor to buy the stock, and Microsoft is paying us more. If we would buy their stock, they're going to give us more earnings if we buy their stock. So that's how you would look at comparing the stock to see if it's more expensive. You compare the stock between the P ratio, which is the price to earnings ratio for the last 5 years, and you divide it to see if the stock is trading, if the P ratio is trading higher than the average or lower than the average. And then you compare it to the competitors. So Apple's competitors are Microsoft. What's another? You might be Dell, Hewlett Packard. Some of those guys are dinosaurs, but you will compare that to those competitors, and then you'll find out. You'll make a decision. Okay, this is the company I want to go to because I know they're going to pay me more. Or you might see something and say, okay, well, Apple is not giving you more earnings than Microsoft, but they're going to sell. They're going to make $500 billion in revenue this year. Microsoft only going to make $200 billion. Well, now they got to change your mind. It's not, wait, okay, I might be getting less earnings from Apple, but their future earnings going to be greater than Microsoft. So you got to take all that into consideration. You got to take all that consideration. And again, I know that might have been a lot of information. If anybody does have a question, just let me know because I just want to make sure everybody is getting the information in real time. I want to make sure everybody is getting the information in real time. So dividend, we told you about dividend. Dividend is basically the percentage of the stock that the company pays each year to the investor as a sweetener. So companies want you to hold their stock, right? And so if a company makes a lot of money, what they'll do is, because we told you own stock, they'll pay you as the investor a dividend. Now that dividend is paid per quarter. So we look at this, y'all, everybody who's watching. If you had 100 shares of Apple, that'd be $19,974, right? Apple's going to pay you $100 per year just to hold a stock, that's $25 per quarter that you're going to get as a quarterly dividend that's going to go into your portfolio account, that whether the stock does good, whether the stock does bad, they're going to pay you. And the reason why they do that is because they want you to be able to hold the stock. And as you're waiting for the stock to do well, those dividends will help you to keep your investment, right, which is your principal, in that particular stock until that company delivers or promise what they say they're going to do. Now, the ex-dividend date is the amount of time you have to buy the stock to get a dividend. So this is going to change in a little bit, right? So the ex-dividend date probably for the next season is going to be probably be in June. So what does that mean? So if you buy a stock, if you buy Apple stock right now before, let's say June 6th, that means you get elected to get a dividend at a quarter. So as long as you keep buying the stock, Apple stock before June 6th or June 10th, you're going to get a dividend. So let's say you buy 50 shares before June 10th, and then you buy another 50 shares after June 10th. What are they going to do? They're only going to credit you for those first 50 shares before June 10th. You're going to get paid off those 50 shares, right? So that's going to be 50 shares, which is $50, right? Divided by 4. So you do 50 divided by 4. You're going to get $12.50 on that quarter. But if you bought the next day, let's say next day, you bought another 50 shares, June 11th. Well, that's going to be accredited to your next quarter dividend, and then you're going to get $25 because now you're going to have 100 shares instead of 50 shares. So just remember, if you're buying dividend stocks, and you want to get paid quarterly from dividend stocks, just remember with the ex-dividend date, that's the last day you can invest in the stock to get a dividend for that quarter. The last day you can invest in a stock to get a dividend for that quarter. And if anybody got a question, you can put it in the chat. So analysts are always going to give you information about what they believe the stock is going to do, and they're going to have targets. And how they use the targets is about how much products and services the company is going to produce, and then they give a guesstimate, or I say an estimate, a very educated guess on what they think the stock is going to do per year. Stock can hit this, it can go over this, it can go under it. So right now, there's a consensus of analysts. I don't know if they can show all of them. I'm trying to see if they got the analysts on here. Okay, so they got a consensus of analysts. There's 46 analysts that gave recommendations, and majority of analysts have said that they recommend that Apple is a buy. So there's got some people that say hold, right? But the majority of analysts says that either Apple stock is a strong buy in the next 12 months or a buy. Majority of the analysts believe that it's a buy. Now, these analysts come from some of the biggest banks in our country, like Morgan Stanley, like JP Morgan Chase, Wells Fargo, Citibank, Citigroup, and they give these predictions. Some might have higher predictions, but then they take all those analysts' predictions and they give an average, and that average estimate was $237. So if you see that this stock is trading under $230, then it might be a good time to buy that stock because it's trading under what the analysts predict for the stock price to be by the end of the year. So they're believing by the end of the year that this stock price should be trading around 237. So that's the case. You have a chance to make 15, 20%. And we told you all the time, 15 to 20% in stocks is good. 15% to 20% in stocks is good. So with all this information that we have today, that gives you a better estimate on how to buy stocks. That gives you a better mindset on how to buy stocks. Now, what I didn't tell you about is the bid and the ask. So basically, the bid is basically the highest price a buyer is willing to pay. And why that matters is if you're willing to sell right now, this is what you get. So people are bidding on the stock market and saying, listen, we want to try to get Apple around this $190 sweet range. But we know that even though the bid is 190, the seller don't want to buy at 190. The seller don't want to sell at 190 because the shares are trading at 199.74. So the ask price for the seller is somewhere at 209, right? So what does that mean? That's the lowest price a seller is asking for. So if you want to buy, right, Apple shares, you got to meet in the middle between the bid price and the ask price. In the middle of that, it's $199.74. $199.74. So people are trading stocks every day. People are buying contracts on stocks every day. And again, you might look at a stock today, the momentum of the stock probably is not even about news about the stock. But there are so many things that make a stock price go up. There's sometimes we don't even know why a stock is going up. It's just people are irrational and they might just want to buy that stock today. And there might be no underlying news for this stock to be going up. So markets are pretty efficient. Markets are pretty irrational. I told you people are irrational. People are going to do crazy things in buying stocks. So because we know people are emotional and irrational, sometimes a stock is probably going to trade so differently than what it should be trading. And you got to be prepared for that. How do I prepare for that? Is by buying stocks long term. Now, there's some people who talk about options. There's some people who talk about trading. I don't do that because I'll tell you, I've worked around in Wall Street. I've worked around, with traders and everything. And I know the average person believe they can day trade or swing trade and all these things, and you might be good. It's not even about the 99% of trades that you do that you're good in. It's about that one trade that you over leverage and you lose all your money. And listen, I have friends who are Harvard and MIT grads who work for the top institutions like BNY Mellon, like Citigroup, like JP Morgan Chase. I got a lot of that's where I worked at. And they still get wrecked. And they're trading with other people money. Now, I'm not gonna say you can't do it, but I'm just trying to get you understand. If these people who have all the technical analysis, they have the fastest quants and charts and computers, if they still get wrecked, I tell people all the time, like, there's gonna be one time where you're gonna get wrecked. It happens in trading. So you say, well, what is the sense about what you can get wrecked in the stock market? You can, but I promise you this. Time in the market will always beat time in the market. So the longer you invest in the company is going to make more money. I promise you this. We told you about the 5 year on Apple, 189%. If you go to all, that's 155,000%. That means if you just would have put $1 in Apple, many of y'all wasn't even born, but let's just say you would have bought Apple, let's say in 2005, your parents would have bought you Apple. It was a dollar and 37 cents in 2005, with all being said, with all the stock splits and all that type of stuff. You could have been set for life. Your parents would even bought you 15 years ago. You could have been set for life. And so it's all about the long game. I know people don't like the long game. People don't like the strategy. But the long game, I'm telling you, is 2 to 5 years. Most of y'all are in your 20s anyway. The ones who are in their 30s, you still got another 30 years to invest in stocks. If y'all do this right, y'all might be a millionaire in really 10 years if you just put, that's to say you put 100 bands in 10 years, that's $10,000 a year, that's $200 a week consistently in the top stocks. You will have close to a million or $600,000, $700,000. I know because I've done this before and I've had six-figure trades. So I know what it's capable of doing. And I'm gonna tell you, it was not big money that I've done this with. It was 25, 30, 50, $75 repeatedly. And y'all seen what y'all MSTX doing. Y'all seen what the 2QQQ doing. Y'all seen today it went up, what, about 12, 13%. So you know it can be done. I'm not trying to tell you it can be done. You're seeing it for yourself as you're applying yourself what the market can do if you buy at any price. I don't care about the price of a stock if I'm going to be investing in the stock for 10 years because I tell you all the time, and I know it's kind of hard for you to understand that because for many of you, like money is the end all be all, but money can't be the end all be all if you're going to buy stock. I'm just letting you know, you know, in this market, I lost 40 grand. I'm not crying about it. because I already know it's just money on digital paper that I'm going to make back, right? And these habits are going to give you the mindset to continue to build, to continue to grow, and to continue to make money. So, money is just a tool that you use to impact your future for the better. So if you look at money as a tool, not a trophy, not the end all be all, then you'll be able to know how to use that tool effectively. You won't chase money, and money will always come to you, and money will always be in your hands. And once you change that mindset from just spending to investing, you're going to look at you like, oh, I could buy those $200 Jones, but I could buy these two. I can put this 200 in the market. The market makes me, let's say, another 50, 100. Okay, in 6 months, I can buy that with my money from the market. Now you're thinking differently. Now you still got the $200, right? Now the marketing gave you some money to buy the shoes, and you still got the $200. And I promise you today, if you take the $200 that you made from working and you buy something, you're never getting that $200 back. You're never getting that $200 back. So this is just a quick and easy guide that I wanted to show y'all. I'm gonna open the floor for questions right now. If you got a question, you can unmute yourself, or you can go in the chat, ask it. If you don't want to unmute yourself, you can go to chat. We got about 10 minutes, 15 minutes for questions. Any question you want to ask. I didn't get a chance to do ETFs, but next week I definitely do ETFs to really explain that for y'all, so y'all can know like how to buy a particular sector of business cheaper than the actual stock price. Because sometimes you don't want to spend $400-$500 on a stock. It's expensive, even with fractional shares. So there's ETFs that tracks particular stocks, or you can buy different sectors of business at a cheaper price. So we'll teach y'all on next week. So that's going to be our class for next week. So I'm opening up for questions. Any question y'all have in the chat about even your personal portfolio or whatever, what you think is what you want me to talk about, some stocks that may be good, or whatever questions you guys have. I want to answer that. So let me know in the chat what questions y'all have. Give y'all a couple of minutes. My baby said, "Thanks, Professor Leonard. You're doing a great." I try to do great. So I definitely want to make sure everybody got their the answers they need. Anybody got any questions in the chat about their personal portfolio, how to buy a stock, whatever? It could be anything. There's no such thing as a bad question, and even if it's a bad question or a stupid question, it's okay. We'll make it a smart question. So we just want to make sure. It can even be about now. It can even be about what's going on now, in the market. Just want to make sure. Can it be? No, that's an old question. Just want to make sure.
Can you hear me?
I can hear you.
Okay. Um, oh, hi everyone, Mariah. But I just wanted to ask you if if you if you get in a trade late, how does that impact everything? I saw the index that you all put in there, and the other one where you talking about like the Beyonce tickets. I didn't get into that one, but I did get into the index, and I kind of got in like behind, I guess, everyone, because I saw where the entry point was, at least where the picture was presented in the chat. And I know, I'm just asking this because I actually did some trading in something called I Am Academy many years ago when
Hmm.
that was around like 2020 and stuff, when all that craziness was going on. So I learned a little bit about trading, but I did know sometimes like you could get in a trade and it's kind of like beat you lost a really good entry point. So I wanted to know, like, how do you know if you have a good entry point, and how do you know you kind of missed that opportunity?
Right now we're in a very delicate time in the market. So let's just say we go to we're gonna do on like right on a job. Like I'm gonna show you everything. So basically, we just look at a particular chart. So let's go. I'm guessing you talk about, did you buy TQQ or did you buy MSTX? Which one did you buy?
I bought TQ. TQQQ, which I guess is the index. I don't know exactly what it is, but I bought that and I bought it at, well, right now it says 45. I bought it, it was like 43 something, like 43.98 or something. But it was kind of, it wasn't, it was late, it was today. It wasn't yesterday because I saw it yesterday, but I had to like get my Robinhood set up again and like do all that stuff. So I did it today.
Okay, yeah, no problem. So I want to show you a very pivotal thing. So this is the 52-week range. So the stock is trade. This is a ETF. So this ETF is basically the 100 largest technology companies that you use. Like even Zoom is a part of this, right? So you got Zoom, you got Netflix, you got Amazon. All those companies are in these holders. I want to see if they got those holders on here. So yeah, so you can see Apple, Microsoft, Nvidia. Um, you're gonna have some Zoom. You might have a couple of digital healthcare companies, communicational services. But I want to show you an important thing. So the stock is this ETF is trading between $35 and $93 a share, right? So even if you bought it at 43, you got it at a good price because what we're doing is we're not trading, but we're buying this for the long term. So we want you to hold this for a year. So we look at just over the last 6 months, if you look at over this trade from February 19th, when it was trading at 90, all the way down to the 40s, you're in a good price if you see this mountain. So you locked in at a good price. So really, anything that's under 70, you in a sweet zone. So what I tell you, continue to buy this until this gets to 70. And it probably will get there at the end of the year. And if it gets to 70, you're gonna make about 50, 60%. And you ain't even gotta worry about a Beyonce ticket. You'll probably be able to get on the flow. Probably not even a flow. You probably be able to pay 1,000 and meet Beyonce or whatever her going rate is. So if you just look at the 5 year estimate of that, you start to see if you would have just held this for 5 years, it's up 188%. If you would just held this particular ETF just in the beginning, it opened like 2010. Like even if you were just, let's just say, when we were 18, I think we are 18 when I was in probably 2011. If you would have bought this, you would have made somewhere between 9 and 10,000%. So that means you would have just put pretty much $100, $200 in there, you'd be a millionaire. So that's what we're showing our people is it don't matter the price as long as you're willing to hold it long term. If you're willing to hold this long term, then you're going to make a lot of money. A lot of money. All right. So we got a question from Diamond. Let's see here. I see she raised her hand. I want to make sure that we.
All right, thank you.
Absolutely. Of course. Of course.
Okay, yeah. So I have a question that was sent to me. So the question is, are 401k still worth it when it's ultimately going to lose a nice portion of its value by the time I need it? This is coming from a 23-year-old.
Okay. Yeah. 401ks is a good start. And there was a time where 401ks was something that you could just invest in by itself and do good. Again, at 23 years old, you have probably another, 30, 40 years of working capital. That's just going to a job, making income. So if you're investing in a company or an ETF or probably target date fund, we told you that it's either American or Vanguard. It's okay investing in a 401k, but just in unprecedented times, we're living in a time of high inflation, right? High inflation. We're living in that time right now, which means that our government is printing more money, right? It's printing a lot of money and will continue to print money, but our economy is not producing at the rate that the government is printing money, which means that the price of money is going to get more expensive. That means our goods are going to get more expensive, things are going to get more expensive. So a 401k is a good start, especially if your company is matching you. I'm not telling you to stop doing your 401k, but what I would give you a suggestion is get out of the target date fund and invest into an S&P 500. So tell your company, who's ever at your HR, I don't want to be in a target date fund. I want to be either in a fund that has an S&P 500 index or NASDAQ 100 index. They might not have that NASDAQ 100. So get the S&P 500 index because that's going to give you at least 12 to 13% more than what the target date fund gives you. So because the target date fund is probably going to give you, somewhere between 6 to 8% on average, where, S&P fund is going to give you 8 to 12% on average. And I have people who I'd advise. One of his ladies, she was in the G funds. That's anybody who works for the government or works for like the post office. She was in the G funds, and she was like, "Man, I had these G funds," and I was showing her she would have probably made 2 to 300,000 more if she would have just switched it to the S&P 500. Still got decent retirement. Probably gonna retire probably like 500, 600 grand, but she'd have probably had like 1,300,000 because she didn't know that the target date funds limit interest because it has a lot of bonds. So what you do have as a 23-year-old is you have time. And time is the greatest currency in investing, no matter about price. When you got a lot of time to invest, the time that you have to invest is going to kill out any price in the stock market. So it don't matter about which stock you buy today. If you're willing to hold them for 5, 10, 15 years and continue to buy them just for 25, 30, $40 a week, you're going to make a lot of money. I promise you. You'll be a millionaire probably. If you do this now at 23, you'll probably be a millionaire probably in the mid 40s or 50s. Probably, if you buy more explosive companies, you'll probably be a millionaire very fast. I'm saying this because I've done this myself. This is how I redeem time for myself. It's just when all my other friends was partying, having a good time, spending their natural income, I was invested in the stock market. And it pretty much saved my life to redeem a lot of time to now whatever I really want to do in life, I can. Now, do I like to work? Of course. Working is wonderful for me. But when you do that, you will save probably 15 years where you won't have to work. And I'm not just gassing you up. I mean, it's really one of my buddies, who was one of my partners in the business. He's 32 years old and he's retired. And I mean, he's 32 years old and he's retired right now. Just wake up, do what you want to do because we started early. I've been investing in stocks since I had my minor account at 16. So that's almost 16 years. So you're in a good age to keep investing, keep your 401k and take a portion, whether it's 7 to 8% of your income, put it in the 401k, and then also take a little bit, $25, $30 every week, and then invest it in some type of low cost ETF, like a SPY, CQQQ. Yeah, Boo, which is VOO. I'm gonna put that all in the chat. You'll be able to see all of those, and you're gonna make a lot of money. And then also try to find some individual stocks that you like and buy those. Whatever you like, whatever you're interested in. It could be Victoria's Secret or whatever. Try to buy some companies that you like that you know about and buy those as well. So that'd be my advice for you. I got room for like two or three more questions. If there are any more questions, we're gonna log off about 3 to 4 minutes. 3 to 4 minutes. If there are any more questions. That was a good question on the 401k too, because that's probably my biggest thing. Everybody want to know about those 401ks. And people think I'm anti 401ks. I'm not anti 401ks, but I just want to say about that. It's a system designed for you to work for 50 years. Really, is what it is. And they really want your working capital. Um, they really don't want you to know about it or really know what you're invested in. They really just want you to just continue to work. And it looks like a benefit that they're really helping you out. But those companies get, kickbacks because if they got 50,000 employees with a 401k plan, they get the kickbacks from, the financial institution. And, it's just a sweetener. The financial institution is making money off them because you can't even get to use that money until you're 65. So it's just a crazy scheme, crazy system. Not saying that it's bad, but definitely you got to know your own money, take care of your own money, take care of your own wealth, because I promise you, your job is not going to take care of you better than you take care of yourself. Okay, so Diamond has another question. Question on the floor. What explosive ETFs do you recommend outside of target date funds? That is a great question. Okay, so I will give you a couple of them that I'm invested in, but it's going to take you to think out of the side of the box, and also it's going to take some time. So one of them is Drive, DRIV. They specialize in autonomous vehicles. So Tesla, Rivian, all those explosive cars, you can buy that. I think it's like $19 a share. Um, if you want to be a little bit sexy, QYLD, right? QYLD is basically QQQ, but it uses options to generate income. And so you can get 13%. Those dividends are paid monthly, right? So let's say you had $100,000, you're going to get $13,760. Rain, sleet, snow, and shine. So let's just say you put 100 grand in there, that take care of your mortgage for the year. My dad's got a large amount in there, and we use that check for him. We reinvest. I mean, if you want to go on a vacation, he uses that money for QYLD. So that's another different rapid innovation, new product. Um, one of my a person that I met, Kathy Wood with ARK Innovation over in San Francisco. She has the flagship fund. That's ARKK. Now people have been, talking about her fund and saying it's been going down, but again, she's got a 5 to 7 year time horizon. 5 to 7 year time horizon. So the companies that she's buying is real explosive companies that as we go through this technological revolution, where we're starting to see AI, where we're starting to see autonomous vehicles, and we're starting to see robotics. That's another one, BOTZ, Global X. It's another good company. They deal with advanced robotics. Um, that's another ETF you probably need to check out. These all are in the chat. And these are high explosive ETFs, high explosive ETFs. Now, again, they're going to take at least 3 to 5 years because some of these companies are new. Some of these companies are just coming on the market and they're just building revenue. They may not be profit, but they're just building revenue. So these are some of those explosive uh, companies that you can get into. And if you just don't want to buy all of them, Tom Lee has one called GRNY. I think it's called Granny Shots, which is supposed to be triple digit return companies and ETFs, GRNY. You can check that out. And you can just go look at GRNY. He owns a company he's the CIO of a company called FundStrat. I'll be at a conference with him probably like next month. He managed about maybe like $7 to $10 billion. So these are all like real high explosive ETFs. But again, you need to wait 5 to 7 years because some of these companies are fairly new. It's just like waiting on Uber, waiting on Facebook to become profitable. It took me about 6 years before Facebook became profitable. And that just happens. And so just understanding it's a marathon, not a sprint. But I'm gonna promise you this: for those of you in the 20s, while everybody is sprinting and you see them making 10, 20, 30,000, this is gonna be the difference between y'all and them. They're gonna lose it all, I promise you. And you're gonna be super rich. And it just won't be no comparison. All my friends that I seen trading in the pandemic got them quick hits, they ain't got that money no more. So that's just say what's the last one? The last one I think is Granny Shots, GRNY, GRNY. On FundStrat is the company. If you look up FundStrat, Granny Shot, you can take a look at that. He's an Asian guy with glasses and crazy hair, but very smart. I met him twice. I'm going to meet him the third time. Very, very smart. We always run ideas with each other. Let me see the last question. So the safe to say we're in the long game. Yeah, and the long game is not really long. I mean, 3 to 5 years. I tell you, if you keep building these habits, you're going to make a lot of money. If you look at the S&P, let's see here, SPY. Let me see if I can go here to show y'all just what a couple of years could do. If you just look at SPY over the last, let's say 5 years, it was up 88%, right? So, you could have bought this at 282. Right now it's at 527. So no matter if this goes down 40%, 30%, you still bought this at 286. You can wait years, it is still not going to hit this level. It's still not going to go back to 285. So as long as you are holding these stocks for a long time, and I promise you, a year we're already in April. So we've been doing this since the beginning of what? February for many of y'all. And y'all already seen money grow. So when y'all was buying TQQ, I think many of y'all was buying it like 41, which is crazy. And it's going to be probably 48 by tomorrow. So another 6% we're going to make by tomorrow. So even if you got in, just figure you got in, let's say 6 months ago when y'all were getting in right around this range, that 38, 39, 40, or even at 43, you still gonna make 10%. 43 to 47, that's 10%. And that's just crazy. That's way better than what the market is doing. So you're getting this at a very good price. So just understand if you got new people coming in, just let them know you're getting really these ETFs and stocks at the cheapest price you can get right now on a trading average per year. So really, you're not really taking. If you know about investing, you're really not taking the risk that you think you may taking. You really are buying at pretty much the cheapest possible price. And when it gets more expensive, I'm gonna tell you, hey y'all, get a little bit expensive. I'm gonna let y'all know we might need to, turn down off the gas a little bit, and buy some other things. So simply when the stock market is going down, people buy bonds for capital preservation, meaning they want to keep the money that they have. The thing about it is the average investor, when they buy bonds, that's the best time to buy stocks because stocks are low. And usually when they sell their bonds to get back in stocks, the train has already taken off. And a lot of people get mad because they're like, man, if I would have gotten there a week ago, 3 weeks ago, 5 weeks ago, I would have made 20, 30%. So I always tell young people, even if you're 40, 50 years old, stay in the market. Stay in the market. Just continue to invest. And y'all invest in $25, $50. Y'all really don't need that money right now. $25 really is just a lunch in today's system of life. So $25 is really it's not that much to really put towards your future. And if you're doing this yearly, you're gonna make a lot of money. So just keep doing it. I promise you at the end of the year, y'all gonna see it and y'all gonna know that it is true. I mean, you're already seeing the gains already, so that's a good thing to see. But at the end of the year, you're gonna see, man. The only thing you're gonna say is, I wish I should have put more. And I had a lot of opportunities where I said, man, I wish I should have put more money. I wish I should have took this vacation. I wish I should have did this, bought this car. I could have put 30,000 in this and made 300,000. So it happens, but just keep on doing it, and you're gonna see, you know, you're gonna see tremendous increase in your portfolio, no matter how the stock is looking. Just keep buying it, no matter the price. I promise you, it's gonna work out for you. And so that's all I have for you today, unless there's another question. I thank you guys again for joining this week. This is going to be on YouTube tonight, so you'll be able to see it on the Next Gen YouTube page. So if you're not subscribed, please subscribe, because that's where all the information is going to be. And we're going to be doing some summits. So we're going to be doing a summit probably soon that I'll tell you about, me and my partner, where we're going to open up 200 people for free. So if you guys want to, it's in a city. We're going to be here, Texas, California, and another city. I'm not sure. So we'll let y'all all know where we're going to be at, and give y'all more information about that. So we thank you all you guys for tonight. I'm going to let y'all get off. I know y'all got other things y'all got to do. So it was a great class, you guys. And always, if you got a question, go to Instagram, put them in the chat. I'm going to get to y'all as soon as I can get to y'all. And thank you guys for having another great class. It was amazing teaching this class with you guys. So you guys have a great night, and we'll see you on next week.